Good morning, everyone. We'll give everyone a few minutes to filter in for just a second. We want to thank you very much for joining us this morning. If you are here, hopefully you are here for the correct webinar. This is the Northern Michigan Chamber Alliance presentation of HR1's impact, how those new U.S. tax provisions are going to impact you and your business. So we want to make sure that we make the most of your time, allowing for questions if possible at the end. So I'm just going to say a quick hello. I'm Nikki Devitt, and I am president and CEO of the Petoskey Regional Chamber of Commerce, but I have the honor of serving as the chair of the Northern Michigan Chamber Alliance. And if you're on this call, I'm going to assume you know who we are, but just in case, we are 20 chamber and economic development organizations strong that reach across Northern Michigan and the Upper Peninsula. And we have about over 7,500 businesses that we represent. And to advocate for your needs, amplify your voices, and really bring you resources just like this. So to tell you a little bit more about the Alliance and about today's webinar, I'm going to turn it right over to Dakota Baker, who is our Government Relations Director for the Northern Michigan Chamber Alliance. Thanks, Dakota. Have a great webinar.
Awesome. Thank you so much, Nikki. And thank you all for being here. This is really, really important information. I'm very excited to bring this to you today, along with my friends Paul and Anthony here from Rehmann. As you know, HR1 is a federal bill that passed, and at the state level, I just want to remind everybody on this webinar that we have decoupled from these tax benefits. So keep that in mind as you're listening to the benefits that are going to be happening for you and your business under HR1, because on your state taxes, these will not exist. That was a decision made in this past budget just a few weeks ago by the state legislature. If you have questions, please submit them with the Q&A box down at the bottom of your screen, and please include your name and email, so if we run out of time today, we can get back to you with your answers. That was the brief little bit I wanted to say to you, so let's get right into it. Paul, Anthony, please take it away.
All right, thank you, Dakota, and good morning, everyone. Welcome to today's presentation, where, as Nikki and Dakota said, we'll be unpacking the newest piece of major tax legislation, and that is the One Big Beautiful Bill, what we'll refer to today as OB3. So just start out with a quick introduction. My name's Anthony Licavoli. I am our Director of Tax Consulting, and I head up our Specialty Tax Services. And with me, I've got Paul Meany, who is part of our tax consulting group and is also a part of our tax credits and incentives group as well. So getting into before we actually get into some of the actual specific provisions here, I do want to start out with a little bit of background on kind of how we got to where we're at today in terms of the new bill, as well as Dakota mentioned, the decoupling in the state of Michigan, which is a significant item as well. So, to do this, we got to go back to 2017, because that really sets the framework for all of this. So in 2017, we had first of all, we had the first Trump administration take office. And that is also the year that, as you can see on the top of the slide there, that we had the passage of the Tax Cuts and Jobs Act, or the TCJA. And the TCJA was a Republican tax bill, and it included I'd say it was probably the most significant tax legislation that we've had since the 1980s. So it included items like the change in the corporate tax rate. So it dropped the corporate tax rate down to 21% from 35%. It included the individual tax cuts, basically the creation of the qualified business income deduction for S corporations and partnerships, the increased standard deduction. So the list goes on and on. But it was a significant piece of legislation. And one thing that was unique in a way, although as you'll see, OB3 used the same process too, is again, in 2017, this was not a bipartisan tax bill. It was a Republican tax bill. OB3 was a Republican tax bill. And in order to get this through the Senate, they had to use the process known as reconciliation to basically avoid the 60 vote requirement in the Senate. Now, there are some nuances with reconciliation, specifically with some of the budgetary rules. So back in 2017, kind of the trade-off was, okay, we'll get this bill passed, but because of budgetary rules with reconciliation, we're going to have to make some of the provisions temporary. They were going to expire or sunset at a certain point. And what they did at the time is they made most of the significant individual provisions temporary. So they were set to basically sunset at the end of 2025. So we were looking at about $4 trillion worth of tax increases that were going to hit individuals starting in 2026, unless Congress did something to act. So that kind of sets the stage for the election last year, when not just the Trump campaign, but Republicans in Congress kind of made it a priority to at least extend these tax cuts for individuals that were going to go away. And so that really takes us into January of this year. We know the new administration basically takes office. And again, one of the things they immediately start talking about is extending these TCJA tax cuts. So fast forward a couple of months, we get into April, and just like in 2017, this is going to be a Republican tax bill. So they're going to have to kick off the reconciliation, the procedural part of the reconciliation process. And they start that in April. By May, the House Republicans passed their version of the OB3. So it wasn't all House Republicans, but it was enough to get the majority there. And they basically, that now goes on to the Senate. The Senate takes up the House Republicans' bill, and they end up basically making a ton of changes to it. And so the version that the House passed is much different than the version the Senate passed. And basically at that point, we're now at the end of June. And so you've got the Senate making all these changes. You've got the president saying, we want to sign this, or he wants to sign this bill on July 4th. And the House is basically not giving up, or not stating a position yet on what they're going to do. So the Senate passes their version of the bill. It goes back to the House, and the House basically accepts all of the changes that were made in the Senate version and passes the law within 5 or 6 days. And it ends up a couple days before July 4th getting passed. It goes to the president, and it's signed on July 4th. So that's kind of the background of how we got to today. So let's talk a little bit about what's in the bill. What's in OB3? So before we get into any of the specific provisions, again, this is sort of high level in terms of kind of how we break it down. And we've got really 3 different buckets here. And so bucket 1 is the TCJA extensions. And so that's exactly what I was just referencing, that $4 trillion worth of tax increases that were going to happen. Well, because we extended all of these provisions, and in many cases made those provisions permanent, that $4 trillion is not going to happen. So that's kind of bucket 1, is all those TCJA extensions. The second bucket on there is kind of what we call the campaign promises. And these were different promises brought up during the Trump campaign. And they include things like, no tax on tips, no tax on overtime pay. There was brought up no tax on Social Security at some point during the campaign. Now, we didn't get these provisions exactly, if you were to think about it in terms of no tax, but we'll talk about what we did get when we get to the individual section of this. In addition to that, you can see on there benefits to U.S. manufacturing. This has been a focal point of this administration, whether it's through tariffs or any other means. There's a clear emphasis to try to benefit and bring back U.S. manufacturing. And we'll talk about a couple of the provisions in OB3 that were really specifically targeted for U.S. manufacturers. And then kind of that third bucket on there is really anything that doesn't fit into the first 2. And these are some of the more controversial items. For instance, we'll talk about the repealing of the green energy tax credits that was used as a revenue raiser for OB3. So we talked a little bit about the history, the background, kind of a high-level overview of the bill. And now let's get into some of the specific provisions. And before I turn it over to Paul, how we have this broken out is we're going to cover the business provisions first, and then with the time left, we'll cover the individual provisions, because as we'll talk about, many of the individual provisions do have impact on businesses as well. So Paul, I'm going to turn it over to you.
So I think one of the first big pieces of news is the qualified business income deduction, which is now permanent. So let's kind of unpack this in plain English. So the QBI deduction, or sometimes you might hear it or referred to as the 199A deduction, is a provision that allows owners of pass-through businesses, such as like an S corporation or partnership or sole proprietorship, to deduct up to basically 20% of their business profits on their personal tax returns. So it was a marquee feature of the TCJA, which Tony was just talking about, for non-corporate businesses to get a tax break. Because if you recall back in 2017, the corporate tax rate went from 35% down to 21%. This affords then the flow-through entities a similar tax break, and basically the new bill allows this to be allows this to be permanent going forward. So what really does this kind of even mean in practice? It means basically if you're a business owner or an investor in a pass-through entity, you can continue taking a substantial deduction on your share of the business income each year indefinitely. So basically, think about if you're a company that generates $1 million in taxable profit, eligible owners might be able to deduct around $200,000 of taxable income, which then obviously translates into tens of thousands of dollars in tax savings each year.
Yeah. So, as Paul mentioned, this is, for any S corp or partnership owner or investor, this is one of the key provisions in this bill. And again, Paul mentioned not only was this, extended, it was made permanent. And so now we're not going to have this uncertainty going forward. If you look over to the right-hand side of the slide there, you can see the different rates that whether a corporation or an S corp or a partnership pay. Well, in a hypothetical, if this was not extended, you would have had your S corps and your partnerships paying close to 40% on their business income because the individual rate would have gone up as well. Now, corporations, again, that was the 21% was a permanent provision. So you would have had S corps and partnerships at about 40%, corporations at about 21%. And corporations, of course, pay tax on the dividend when they get that, when they actually distribute that. But the one thing that you would have seen and that we were dealing a lot with was S corps and partnerships interested in converting over to C corporations for this potential tax difference. Because although the effective rate is about the same with the dividend, you do have control in a C corporation when you pay that dividend. So, in Paul's example of $1 million, in the corporate level, you'd pay about $210,000 in taxes. You don't have to then distribute out any of that additional money in the business or cash in the business. You could then use that and reinvest all of that. At the S corp and partnership, you don't have that choice. You pay tax immediately. And so you wouldn't have had that option of deferral. So now that QBI is permanent, we don't have to worry about this rate differential because in a partnership and an S corp that is eligible for QBI, they're going to end up paying a lower effective tax rate than a corporation that also distributes out its profits.
So kind of transitioning from one tax advantage to another, 100% bonus depreciation is now permanent. So bonus depreciation essentially means, right, you can immediately deduct, in this case, 100% of your costs of eligible business assets. So think about your machinery, your equipment, computers, potential vehicles themselves in the year in which you place them in service. More times than not, right, when you purchase them, rather than spreading out the deduction over several years. So this is another one of those big gifts to spur investment. During the TCJA in 2023, the way it was written was there was a phase down approach. So in 23, you could only take 80% bonus on your asset, 24, 60, 25, 40%. And so this was going to phase down to completely expire by 2027. But the new bill basically says we're keeping full expensing around for good. So starting in 2025, right, you're going to be able to write off 100%. And so that's restored and made permanent. Now, one thing that's important to note is there is a weird timing detail there where property acquired in the first few weeks of 2025, I think January 1st to January 19th, only qualifies for 40% bonus depreciation. And you might ask, all right, well, why is that the case? And it's because the law wasn't in effect on January 1. And at that point, prior law had bonus depreciation at 40%. So this was basically enacted so that starting on January 20th, 2025 and onward, you would then receive your 100% expensing for new assets. So this matters because from a cash flow perspective or financial perspective, full expensing is huge, right? So it lowers the after-tax cost of any new investment. So it, not only just boosts cash flow, leaving more money for businesses and provisions to reinvest or handle other needs, right? It's basically evidence that, can spur business investments, especially among smaller or cash-constrained firms themselves.
Yeah. Yeah. And, well, first of all, it's not a coincidence that January 20th was Inauguration Day. That's specifically why it was carved out that way. But this is, we talked about the QBI deduction on the last slide being, the biggest news for S Corps and partnership holders. This provision here is probably the most broad-reaching provision just in general inside of the business provisions that are out here. So if you think about acquiring fixed assets and the ability to write those off, as Paul had said, that is going to impact the majority of businesses. So, I mean, unless maybe you're a service business or something, or have no physical footprint anywhere, you are going to be acquiring assets and now having the ability to expense those all, and knowing that this is a permanent provision is a significant item. So when we get down to the cost estimates that the joint committee put together, you'll see that the bonus depreciation is one of the most expensive of the provisions on the business side, because again, it is or I'd say it is the broadest reaching of any of the business tax provisions.
Before we jump into this next section, I think as we go through this presentation, one thing you'll notice is basically a lot of this just helps with planning, right? So there has been a lot of uncertainty regarding timing and the implications due to phase outs or things set to expire. And I think what this bill does, in addition to incentivizing domestic production and investments in the US, is it allows us now to basically confidently model major purchases for a variety of different things. And so one of those actually then is the new qualified production property, so 168, which basically is a new incentive that we really haven't allowed previously, which now allows for immediate expensing of certain commercial building costs. So this is qualified production property. And basically, in its most simplistic terms, if you build or invest in facilities that are used for domestic manufacturing or other specified production activities, you'll be able to deduct 100% of those construction improvement costs right away. So similar to, bonus depreciation, which we just discussed, except this is for structures. So this is really nice because under previous law, a building like a factory or a warehouse had to be depreciated over 39 years. But now, you can potentially deduct it in 1 year. So this is a significant tax break aimed at really encouraging domestic production and capital projects. Now, the really nice part about that is, as we just said, it basically means non-residential real property that is used as part of the qualified production activity. But the key piece is, what is qualified production activity? And really, when you think about what that means, think about manufacturing, production, refining of tangible products, These are your factories, your manufacturing plants, your processing facilities where you're making things. So this is where the law is geared specifically, to boost investments in these sectors. There is a caveat where not everything will qualify. So things unrelated to core production are excluded. So you could think about, where you're certain office infrastructure, or if you have a cafeteria, those might be excluded from that. However, this is still a significant incentive when you think about, should we, build a new or expand upon an existing facility.
Yeah, this is a big one here for manufacturing. I at least since I've been practicing, I've never seen a provision where 39-year property could be immediately expensed, or a portion of 39-year property. So the one thing that Paul had mentioned, and that's key to this, is your business engaged in a QPA, a qualified production activity? And that's one of those areas that the IRS will be releasing some guidance on what is a QPA. So right now, what we've kind of seen is there's maybe a spectrum. And so on one end of the spectrum, you've got a business that's clearly going to qualify. So think about some type of let's say an auto manufacturer who's taking a bunch of components and producing a vehicle. Well, clearly substantial transformation is taking place. They're clearly going to qualify for this. The other end of the spectrum, you're going to have businesses that clearly don't qualify. Your wholesalers, resellers, businesses like that, where no substantial transformation is taking place. And then you're going to have all the businesses in between. And that's something like you're taking a component, making some minor alterations to it, and then moving it along the supply chain. Is that going to qualify? What is going to meet that definition of substantial? And so that's one area that we're definitely looking forward to some guidance from the IRS on.
So just kind of building off this a little bit more. So basically, if you're a manufacturer, right, considering to build a new plant or expanding on an existing one, this provision essentially drastically improves the project's tax profile. So a lot of times, right, when you're making these decisions, right, it's an upfront cash flow financial decision. But now, right, it's what is the effect a year later when you ultimately go to pay taxes, and this now can ultimately kind of help shape or impact that decision on, is this capital investment worth it? So a key takeaway here is, right, if you're in the industry that produces tangible goods, again, you're manufacturing, your agriculture, your auto, your processing, your refining, right? This is basically like a big sign that says, invest here in America, right? We are going to provide an infrastructure, a tax infrastructure, right, that will help allow us to kind of start to develop as maybe we historically had. So, I think it's a great opportunity for companies to evaluate, right, what are their capital project pipelines, right? So, obviously it's key to make sure we're understanding, right, the qualifying criteria before embarking upon one of these large endeavors. But that being said, right, this could be an opportunity if you were thinking about, right, expanding or creating a new facility itself. And what's really nice here is if you start to think about the totality of a lot of these impacts, right, you've got 100% bonusing. All right. So if you're buying your assets, right, your equipment, your machinery within the facility, right, you've got 100% bonus on that. You've now also, with this qualified production property, got the ability to now deduct non-residential real property, which is something we hadn't been able to do. And then as you'll see as we go on to the other sections, right, there's other benefits, whether it's a deduction or credit, so that when you think about, all right, what would this project actually cost us? I think you start to see there's this aggregate impact where you can actually get a pretty good ROI when you start to invest in, right, plants, machinery, equipment, production.
Yeah, definitely. So one thing just to point out on this slide here, this last bullet point, this lease property restriction. And so this is one, again, we talked about needing more guidance on a QPA. We also need more guidance here. And so if you look at the way the statute is written, there is basically a entity that is leasing the property is not qualified for QPP. And so what I guess what a lot of our clients operate as is basically you hold the operations over in an entity and you've got the real estate over in another entity for legal reasons, tax reasons, and there's a lease between a related party lease between the two parties. So, this is one area that if you just looked at the letter of the law and you just kind of read it straightforward, it would seem like that wouldn't qualify. But if you look at the intent of this, that was not the intent, and so we're hoping that the Treasury releases something soon that basically says, hey, for related party leases, there's an exception to this lease party restriction here. So just moving on to the next slide, Paul had talked about kind of adding up or aggregating all these benefits, and the cost aggregation study is one significant item that should be looked at if anyone is building a facility. So this was the case even before QPP or 100% bonus, but these provisions just get that much more powerful the cost segregation study gets that much more powerful, more beneficial with these new provisions. So, if you look at our example here, well, just to actually step back, a quick description of a cost segregation study for those who have not done them. It's basically engineers coming out to your facility and taking the building, looking at pictures, blueprints, and basically pulling bits and pieces out of the building that qualify for 5 or 15-year life property. So Paul had mentioned that a building's 39-year property. Well, cost segregation study moves a portion of that over to lower lives. And not only do you have a shorter depreciation life, but 5 and 15-year property is also eligible for bonus depreciation. Bonus depreciation is now back to 100%. So if you look at this example here, let's say we are a manufacturer who's engaged in a qualified production activity, and we're thinking about building a new facility. $5 million cost basis here. So we've got 39-year or really 40-year depreciable life property. So in scenario one, if you were to just depreciate normally, not do a cost segregation study, you'd get about $120,000 worth of depreciation over every year for the next 40 years. It doesn't work out exactly that way with the math, but basically that's what you'd end up with. And so if you just think about the time value of money, what is that $120,000 deduction going to be worth to you in year 20, in year 30, in year 40? Very little at that point. And so what, again, a cost segregation does is it can move and accelerate some of that depreciation. So if you see scenario 2 here, now let's say you do a cost segregation study on the building, and that cost segregation study comes back that about 30% of the building is really 5 or 15-year property, shorter life property. Well, now your first depreciation goes from 120,000 all the way up to about $1.5 million. Significant jump, significant tax savings in that initial year. Then if you look at scenario 3 and you layer on a QPP study with your cost segregation study, qualified production property here, because we're in this example, a manufacturer. Let's say that QPP study comes back and it says, okay, 80% is qualified production property. Because if you remember, we've got exclusions here that we need to carve out. But let's say in this example, 80% is QPP. Well, that remaining 20%, we can also then do a traditional cost segregation study on. And so in this example, you end up with $4.3 million of depreciation in that first year. So you go from $120,000 all the way up to $4.3 million of depreciation. So, when you're modeling out, the cash flow, your cash flow and basically your tax bill, imagine having an additional $4 million of a deduction with the same scenario. The only difference is you've gone down the road of a cost segregation study. So a really significant item there if anyone is thinking about constructing or expanding an existing facility.
So now we want to talk about just another limitation that the OB3 bill addressed, which is interest expense deductions. So if your company carries significant debt, you're likely familiar with the business interest expense limitation. But basically, this rule brought in by the TCJA limits the amount of interest expense a business can deduct in any given year to a percentage of income. So from the limit was 30% of EBITDA, so earnings before interest, tax, depreciation, and amortization. But starting in 2022, it was tightened that 30% to EBIT, so earnings before interest and taxes, and then after depreciation and amortization. So they kind of dropped depreciation and amortization, which ultimately basically had a harsher limit because you're not adding back depreciation, which basically essentially means that the smaller income base to measure that 30% of. So many capital intensive or highly leveraged businesses, for example, would see their deductible interest drop due to that change. And so one of the reasons why I think that matters a lot is, if your company has a lot of interest expense, so this is, common if you're a real estate company or privately equity owned or any business that really finances a lot of operations, you'll now have an easier time deducting all of that interest. So fewer companies will now hit that 30% threshold, which was obviously a lot easier which you would hit a lot quicker when you only had it when you didn't include depreciation and amortization. So this essentially potentially lowers taxable income and taxes for heavily leveraged companies. So in short, right, financing costs remain fully deductible, which is good news for both business investments and expansions. And then while we're on the topic of deductions and reporting, the other thing we wanted to note here was compliance relief for 1099 reporting. So many of you may have been following kind of the recent changes in IRS reporting for payments. Well, this law basically increases the reporting threshold if you pay out 1099s to $2,000 adjusted for inflation. So basically, in practical terms, really what this means is if your business pays an independent contractor or a service provider, you don't need to issue a 1099 unless you paid them at least $2,000 in a year. And this is up from $600. So this reduces paperwork for, small transactions, which is really nice and convenient.
Yeah, the only thing I'll point out on this slide, this new 1099 or higher amount is effective starting in 2026. And so in 2025, you still have the old amount, which I think was $600. So you'll have one more year of potentially more 1099 filings, and then in 2026, it will jump up to that higher amount.
So, one of the unfortunate rollbacks through the new bill were the energy tax credits. So basically, it rolls back or trims some of the clean energy tax credits that were expanded just a few years ago under the Inflation Reduction Act. So while our focus today is on like business transactions, many companies have been or were planning to be involved in projects or purchases that rely on these energy credits, whether that may be, installing solar panels on facilities or buying electric vehicles for a fleet, developing renewable energy projects. So we think it's important to at least, note, right, the landscape has changed here. So essentially, OB3 accelerates the phase outs and termination of multiple energy incentives. And so, for business leaders, I think, the main thing to digest is, right, the generous energy clean, or I'm sorry, the clean energy incentives where we were receiving significant tax break have now been pared back. So one of the other areas is research and experimentation. So Tony mentioned I'm in the credits and incentives group, but if there's one change that I think had also another significant impact to the economy, it would be this one. So effective basically for years ending after 2024. So I think 2025 tax years and going on, right? We can now fully expense, right, the domestic R&D costs that are incurred in the year. So this reverses, if you're familiar with R&D, the unpopular opinion where you've had to in the last 3 years capitalize and amortize research and experimentation costs over 5 years if they're U.S., 15 years if they're foreign. So basically, to put this in an example, right? Prior to this change, right, if you spent around $10 million on developing a new product or software, you could only deduct around $2 million or 1/5, right, each year for 5 years. Under the new bill, right, it fixes this. So you'd be able to, assuming, right, all $10 million is R&E eligible, you'd be able to deduct all of that in the immediate year itself. So that's a huge restoration from a tax benefit, really aligned with innovation itself. So one of the other areas that I think is important when we think R&D is there is within the new bill legislation regarding, eligible small businesses that have had to pay taxes on R&D due as a result of the capitalization and amortization rules. So there's a lot of companies where maybe you weren't initially thinking you had to pay any taxes, and then because of this, you were shifted into a tax liability situation. So if you meet the definition of an eligible small business, which means your average gross receipts are under 31 million over the prior 3 years, which is the test for 2025 and inflation adjusted, you do have a unique opportunity where we can retroactively deduct R&D costs from the 2022 to 2024 time period. We have up until January or July 6th of 2026 to address that. But basically, it allows us to turn back the clock to claim those tax benefits for R&D expenses for those years. So you would do this via an amended return. Now, if you're a larger company, right, you don't necessarily get that retroactive fix, but thankfully in 2025 and onward, you will be able to basically take any of your unaccrued amortization and deduct all of that either in 25 or spread out between 25 and 26. So like we mentioned, that 5-year period, right? If you had to capitalize something in 22, right, you would still have the 25, 26, and even 27 because there's a mid-year convention aspect to it where you could take all that unused or unaccrued amortization and deduct it in 25 and or 2026. The great part is the default now becomes, right, immediate expensing is back. However, you still have the option to capitalize if you wanted to. That would only be for unique circumstances. But I think the key point here is, right, you are now able to get back to deducting a lot of those expenses in addition to what we'll get to in a second, which is just the R&D credit itself, which is a dollar for dollar savings against a company's tax liability. So we just talked about the capitalization and amortization of research experimentation, but that also is kind of synonymous with the R&D tax credit, which is extremely valuable because, like I just mentioned, right, it does reduce your taxes dollar for dollar. So the Section 41 R&D credit is still around. The definition is unchanged through the OB3 bill, but companies should remember that full expensing R&D doesn't necessarily negate your ability to claim credits for R&D spending. So you can often do both. So this is one of those where, yes, you get to deduct those costs and you're getting that tax credit, which is really beneficial. So maximizing R&D credits remains a very smart strategy alongside the new expensing rules. So given the enhanced deduction landscape that we've just gone through, I think it's important to reevaluate, right, the R&D credit strategy, ensuring we're capturing all those qualifying activities for the credits, considering, potentially new elections, the credit deduction trade-offs, documentation, things of that nature. Transitioning just from the federal to the state really quickly. So, right, many of you operate in multiple states, or at least file state taxes in addition to federal. And there are many states, the vast majority of states that have some form of an R&D tax credit as well. Well, Michigan has brought that back. It had not been around the last couple years, but reinstating the Michigan R&D credit as of January 1st, 2025. So this is, I know we're about to talk about decoupling for some things, but this is where they've decided to band together with the federal incentives, right, to spur innovation at the state level. And so having no state R&D tax credit for a while, I think this then brings back, right, the incentive for research and development to spur that innovation and growth. So the credit, essentially, when we think about the Michigan R&D credit, rewards companies for investing in R&D within Michigan. So if you're a large taxpayer, the credit equals 3% of your qualified research expenditures, up to a base amount. That base amount might be the average of past expenditures, similar to the federal incentive if you're familiar with it. Similarly, there is for small businesses an even more generous threshold up to a base amount, and also a tiered approach, meaning that small firms can get a bigger bang for their buck for additional R&D spend compared to even your larger companies. The other nice part is, right, it does reward investing in universities, right? So if you are working with them, there's additional benefits you might be able to receive as a result of working with or contracting with, for example, in the pharmaceutical or biotech industry. So Michigan has set kind of an annual statewide cap of around $100 million for this program, but 25 million is reserved for small businesses. So there's a lot of companies that are likely going to start to apply for this, but at least they've thought about, right, creating some sort of proration so that larger companies don't take the vast majority of that $100 million pool. briefly just on what that application process looks like. So again, mentioned it's effective as of January 1, 2025. Basically, businesses, we must submit essentially a tentative claim by April 1st of 2026 for the 2025 expenditures. They will not allow a late filing. You must file that tentative claim by, again, April 1st to lock in your eligibility for those 2025 expenses. So the best way to think about this is it's basically like reserving your spot in line, right? So if you miss your deadline, you can't claim the credit. And then if there is more than $100 million that has been submitted, then there will be a proration effect where you get a distributive share of that pool based on the various companies that have applied.
Yeah, and that item right there that Paul just ended with is key, right? We've got, on the federal side, right, you calculate your R&D credit, and assuming you don't get audited or adjusted, that's the amount that you're going to be able to take. On the state side, specifically with Michigan, there is a cap to how much the state can award on an annual basis of $100 million. And so that's our biggest question right now is we're not sure how much is going to be applied for or what that haircut, because Paul said there was going to be a proration if more than $100 million is applied for. And so you're not going to know exactly what your credit is until the state comes back and determines how much it can award on a pro rata style. So just sticking with the state of Michigan here, as Dakota mentioned, a very significant change happened a couple weeks back with the new Michigan budget. And basically, as a revenue raiser, the state has decided to decouple or not follow many of the significant provisions that we just discussed on the business side. And if you look at this list here, bonus depreciation. Well, for a corporate side, we're never able to take it anyways, but now that's going to apply both to corporations and pass-through entities. Paul just mentioned the ability to deduct our research and development expenditures. So you can still take the credit for the state of Michigan, but for the state of Michigan, you cannot deduct those R&D expenditures. You have to capitalize them and amortize them like you did for federal purposes a year back. And so what that means is not only a higher tax bill for the state of Michigan, but you have to actually go through the exercise of calculating your R&E expenditure capitalization amount and doing your amortization each year. And so there's additional tax, but there's going to be an additional compliance cost to your business too, because someone has to go through and perform those calculations. Someone has to go through and adjust bonus depreciation. If you are subject to the business interest expense, that's another area they decoupled from. Qualified production property. Although that would be more on a limited basis than something like bonus depreciation, you're not going to be able to deduct that building in that initial year. You're going to have to depreciate it over a 39-year period. And so when you add these up, you're going to end up with examples where companies on the federal side have a large loss because of bonus depreciation, because they're going to be able to deduct their research and development costs, especially in 25 and 26, when they're going to have these large deductions of previously capitalized costs. So that's going to be on the federal side. And on the state of Michigan side, you may end up with a significant amount of income because of these decoupling provisions. So definitely, anyone, and I know most people on this call, I'm assuming, are operating in the state of Michigan. This is one of those provisions that you really got to look at when you're modeling out your estimated tax payments, because this can completely swing a loss into significant income for the state of Michigan for that year. So moving on away from the state of Michigan, 1202 stock, qualified small business stock. This was a pretty substantial benefit prior to OB3. And basically what it allows owners, investors of C corporations to do is basically invest in C corporation stock. And if it's qualified and if they hold it for 5 years, they can sell that stock and pay no capital gains tax on it, at least if they were issued it today. There's different rates that go back into the 90s and 2000s, but that's the idea behind it. And so very powerful tool. If you are an owner of a C corporation, you can basically exit or potentially exit tax-free. So what OB3 did is it increased some of the, or enhanced some of the different provisions in 1202. I'm not going to go through each one here. You can look at it. But basically they made an already good provision for owners, investors, and C Corps even that much better. In this last slide on the business section, it's really just showing the joint committee estimated cost for each provision. I'm not going to go through all these, but just want to point out, again, you'll feel like I mentioned 100% bonus depreciation being one of the most expensive. You can see here the estimated cost is about 360 billion. And if you just kind of go down to the last one in terms of revenue raisers, Paul had mentioned terminating all of those green energy credits that were part of the IRA. You can see there that's estimated to raise up to about $500 billion. That's going to pay for a lot of the other business provisions included in the bill. Okay, so we're going to switch gears a little bit. We're going to move over to the individual provisions. Now, the goal is not to cover every one of these slides. We'll make these slides available so you guys can look at them on your own time. But we do want to point out a few of them because they are going to have significant impact, especially for our S Corp and partnership owners. So Paul, I'm going to turn it back over to you to cover the first couple of these.
Yeah, no, absolutely. So, as Tony mentioned, right, when we want to highlight the individual tax rate changes because they really do form the backdrop of many business owners for personal tax planning purposes. So again, while the primary focus has been on the business provisions, right, many of you as executives or proprietors pay taxes through the individual system. So the new bill essentially permanently extends the individual tax brackets and rates from the TCJA. So meaning the lower tax brackets introduced in 2018 remain in place beyond 2025, avoiding kind of any sort of reversion to higher pre-TCJA rates. So for example, right, the top marginal rate stays at 37% going forward, instead of bouncing back up to 39.6% as it would have in 2026 without this bill. So all rates essentially across the board, in the bracketed spectrum basically stay within their TCJA levels. Or the
Yeah,
2018 to 25 levels.
yeah, and just these amounts here are the post TCJA, so these are the 2018 rates. Since then, they've been adjusted for inflation significantly. So actually, the top tax bracket right now, because of the extension of OB3, is actually somewhere closer to, instead of 600,000, you don't actually get into that top tax bracket until you're around maybe 750,000 at this point.
So, additional to the income thresholds, one of the other things is basically the new bill keeps the higher standard deduction in place permanently. So, the standard deduction currently around 30K or so for joint filers, 15K for if you're single, and even going slightly higher as with 2025 with inflation, will not drop back down after 2025. So, this is significant for individual taxpayers and families, though many high-income folks itemize deductions, so it may not directly impact business owners per se, but because of the itemized deductions, but it's part of that overall tax relief picture, right? So in short, right, the tax regime itself for individuals has gotten used to this 2018 precedent, and essentially, right, this is the new norm going forward. So no automatic tax increases will hit in 2026 for income tax rates. So from your personal tax planning perspective, you can proceed with a little bit more certainty.
Yeah, you can, and you look over to the right hand of the slide, you can see just how many people utilize the standard deduction. So even before it was enhanced in 2017, 70% or so of individuals used that deduction. After the enhanced amount, it went up to 88%. And right now, it's somewhere hovering around 93 to 94% of people use that increased standard deduction amount. So, it's no coincidence when we get down, if we have time, into the cost of the individual provisions. This is, we were talking about billions of dollars on the business side. We're talking about trillions of dollars when we look at some of these, the cost of these individual provisions. And it's no coincidence that this is one of the most expensive ones, because you can see it impacts, in this case now, about 93% of Americans benefit from that higher standard deduction amount.
Real quick, one thing to note from that prior slide, as an employee, if you're thinking about your employees, they're not now necessarily facing that higher tax hike, which could indirectly affect things such as your salary negotiations or your fringe benefits. So the economic environment again stays more predictable, and I think that's something that's really important for business leaders themselves. And then and starting in 2025, the child tax care credit will increase to $2,200 per qualifying child. So the important thing here is to note that it will now be adjusted annually for inflation. So ensuring it keeps pace with, rising living costs over time, which I think is something that is everybody kind of experiences or has been experiencing. And then regarding the alternative minimum tax, or referred to as AMT, basically, this is a parallel tax system designed to ensure that high-income individuals, trusts, or corporations who claim many of those, I'm sorry, individuals and trusts who claim many deductions or credits really pay their minimum level of tax. So under the new provision, the anti-exemptions and phase-out thresholds are permanently expended with exemption amounts indexed for inflation.
Yeah. So moving on to this slide, the estate and gift tax, again, which is another system that we have set up for taxing wealthy estates. This was a significant item if you are in a position of having a taxable estate. And so basically the exclusion, the lifetime exclusion was made permanent at the higher amount of $15 million. So that means that, a husband and wife could pass on $30 million or so of net worth to their heirs tax-free. This amount has been made permanent. It's gonna continue to be indexed for inflation. And it's a very, if you're thinking about estate planning, having this permanence or this certainty, although Congress could in theory come in and change it at any time, but it's always been a temporary and kind of moving back and forth. So having this kind of certainty is very helpful when it comes to any type of estate and gift planning that's going on. So this item here, the SALT cap, probably one of the provisions that was getting the most attention, whether in the media, the news, and certainly among Republicans in both the House and the Senate. And the SALT cap is basically a limitation that came in back in 2017. It basically says you can't deduct more than $10,000 of property taxes, state income taxes, and so forth. So, if you incurred $50,000 that year, it doesn't matter. You can only deduct that $10,000. So this cap, this $10,000 was raised on a temporary basis up to $40,000. But it's important to point out that the additional amounts phase out. So if you are making more than a married taxpayer making more than $600,000, by that point in time, you would have reverted back to the original $10,000 deduction. So it's not like everyone can benefit. There's a gap in the middle there where people are paying enough to where it makes a difference, but they're not making too much money to where they lose that additional benefit. The other thing I just want to point out for our business owners, and especially in the state of Michigan, the state of Michigan offers the pass-through entity election, which is basically a workaround for business owners of this limitation for your S corps and your partnerships. That is still as important as it was prior. So, if you actually do the math, even in many cases, if you can benefit from this increased cap, it still makes sense to actually utilize the state pass-through entity election and not try to deduct it through your individual tax return. All right, so we're going to skip down to the qualified tips and overtime, and these really kind of go hand in hand. I'm not going to cover all of the bullet points here, but basically, we talked about no tax on tips, no tax on overtime. Well, what we got was a deduction at the individual level. So these are people that are making the tips, making the overtime, not the businesses. But there's a deduction at the individual level for tips and for overtime up to a certain amount. Now, both of these provisions have a phase out threshold. So if you are making over $550,000, I don't know how many people that are tipped that are making over that amount. But if you are, you can, in theory, phase out of that deduction. So so I guess what do both of these provisions mean for business owners? So whether it's tips or overtime, you got to give this information to your employees in order for them to know what their deduction is going to be on their individual tax return. And so right now, the 2025 W-2, the IRS has come out and said we are not changing it. And so there's not going to be a section to report this amount. In 2026, there will be. And so, and actually, as of yesterday, the IRS released a notice basically saying they won't penalize employees for reporting or not reporting this information, sorry, employers for reporting this information late to employees. So the idea is you would likely want to get some type of information out to your employees that shows them their amount of overtime and their amount of wages paid as well. Or sorry, tipped amounts paid as well. So stay tuned, I guess, for more on these two provisions as a business owner. They're going to be important when it comes to specific reporting for your employees. Okay, skipping down we're going to go down to the last provision that we'll cover here, which is just the Trump accounts, because it is one that we do get a lot of questions about. And so basically, these are new types of savings vehicle that can be utilized for children under the age of 18, or really beneficiaries under the age of 18. There's the one question that we most often get on this is because if you have someone born between 2025 and 2028, the government will fund at the first $1,000 of the account. So the question that we get the most of is, how do we get that $1,000? And the answer is, we don't know yet. That is supposed to be coming out at some point in 2026 in order when you can actually start, right? They've got to build up the infrastructure for these accounts. And so stay tuned in 2026, but it's definitely something, even if you don't fund it beyond that, something to consider for anyone born between those years. And as an employer, you should also consider, when you're looking at maybe incentivizing employees, is you can also contribute up to $2,500 possibly per year. We think that's what they intended, tax-free to the employee to their dependents accounts as well. So just consider that as all when you're trying to think of creative ways for employee benefits. All right, so we're gonna, we're just about out of time here. So, we'll wrap up with this slide here. The prior slide before, you can see some of the costs of these individual provisions. As you can see, we're talking about trillions, not billions, as we were on the business side. But in terms of kind of what is next, if anything's next, in terms of new tax law, Speaker Johnson, Republican Speaker of the House, had mentioned that back in July that Republicans were going to try to work on a second tax bill. The chance of that happening, I would say, is pretty much zero, based off the fact that the government's been closed for so long, and we're not sure when it's going to come or reopen. And so, there may be some more talks coming about this. Republicans may have another chance to use reconciliation to pass some additional amounts as well. So, just stay tuned for any information on that. The last slide here is just a link to our external Rehmann.com page that houses all of our OB3 resources. So if you had any interest in kind of doing a little bit of a deeper dive into any of the topics that we just covered, we've got a series of articles there that go into all the things, again, we just mentioned in a little bit more detail. So check that out. And I know we are out of time for questions. So I just want to thank everyone for joining us. I'm going to turn it back over to Dakota to kind of wrap things up.
Fantastic. Thank you, Anthony and Paul. This was an excellent and very informative webinar. We really appreciate you taking the time to do this with us today. We do have a couple of questions rolling in, so we will make sure that we get those to you and get those answers out. And then everybody can look for, within 24 hours, we should get you an emailed version of this as well, so that you can see the recording, follow along with it, go back to the parts that you feel may be most applicable to you. And please feel free to reach out to us if we can be of any further assistance as we continue to understand what is and is not happening with all of these different provisions. The Northern Michigan Chamber Alliance is here to help serve with this and many other things. So we're always here to be a resource for our business communities. Thank you for your time today, and we hope you enjoy the rest of your Thursday.